to pick the virus up from one person to another, and much more easily than an average type of flu or influenza. So because it's so contagious, one is needing to implement all of these new rules in terms of how people are isolating themselves and keeping their distance, etc. Of course, the problem is that, as we've seen with the virus, is that for the vast majority of people, it will be a small issue. You will feel ill as if you've got the normal flu, but it is really in two sets of people that we have the problem. The problem is in the elderly, roughly people 60 to 70 years and older, and then people who have sort of chronic health issues, particularly respiratory issues, issues like HIV, issues like TB, and where you have low immune systems. So in the elderly and those people with impacted health issues, the death rate is abnormally high and around about the 10 to 12% figure, which is of course high. So this is where the problem lies, and that is because the virus is so contagious. The problem is that if it spreads extremely rapidly, guys, somebody is not on mute. If this virus spreads rapidly, the problem is that not only in South Africa, but all countries, the health system will collapse. So there are not enough hospital beds, there are not enough ICU beds, there are not enough ventilators, etc., for the rapid spread of this virus, and then the proper medical care for the elderly and the sick. So as a result of that, and not wanting the whole health system to collapse, what governments are needing to do is lower the rate at which the virus is spreading, and hence push the amount of people that are going to need hospitalization further into the future. So the whole emphasis on all of these measures that are being implemented globally is to slow the spread of the virus, and in that way allow the health systems across the various countries to manage and cope with the ill people. And of course, in that way, to hopefully give everybody as best medical care as possible and minimize the deaths and mortality, etc., of people getting the virus. So that is really, in a nutshell, why all these procedures are being put in place, is to contain people, to stop people having contact with each other, and in that way stop and reduce the spreading of the virus. So that is sort of park that as the first step. What is then the economic effect of that? The economic effect of that, of course, is that it has caused, literally in the space of 10 days or so, a virtual shutdown in the global economy. So we've seen massive effects already in certain industries. Of course, the most obvious one is the airline industry. So airlines across the world have virtually come to a standstill. The number of flights and capacity on flights is down something like 80%. And estimates are that by the end of May, if all these global travel bans continue as they are set, that up to 90% of airlines could be bankrupt, as an example. So already governments are having to provide over $50 billion of funding, for example, to the airlines to keep them going into the longer term. So that would just be one example of an industry. The biggest economic impact is going to be really on small and medium businesses. And again, in that part of the industry, we will see it. For example, things like tourism, things like restaurants, shops, retail shops in shopping centers, where suddenly nobody's going to restaurants, nobody's going into shopping centers, nobody's traveling, booking into hotels, etc. It's going to have a massive impact on these businesses that can't rely for very long without monthly cash flow. So businesses will literally just run out of money and need to close down. And of course, that leads to then job cuts, losses of jobs, increased unemployment, etc. That has another whole ripple on unemployment effect. So what you are thus seeing is a very rapid slowdown in economic activity. And it's really this slowdown in economic activity that is causing the share prices and the stock markets to fall so significantly. So businesses are definitely, without doubt, going to have significantly less turnover, significantly less revenue, which means less profits. And if businesses are making less profits than what they were expected to make, that means that from a valuation perspective, they are worth less, and hence their share price should fall, and that is what the market is pricing it in. Now, whether the market is pricing in too much bad news is what, is the uncertain part, and what time, I guess, will tell. The other part of the economy that's been then highly affected is when you have this massive economic slowdown, it has ripple-on effects, for example, into the resources and supply or demand of oil is what we've been seeing. So, of course, China, which is the biggest consumer, first of all, of oil and things like platinum and steel, they consume more than 55% of the world's supply of steel, platinum, iron ore, etc., a lot of which, for example, comes from South Africa. The Chinese economy has shut down, as we know. It has a material reduction in the demand for these resources. So that's why we've also seen the prices of resources fall heavily. And of course, we've seen the price of oil drop massively. So oil was priced at about between $55 and $65 a barrel of oil. A month ago, it fell all the way to $30 a barrel and is currently, fluctuates between $28 and $33 a barrel or so. So the oil price has halved in the last 2 or 3 weeks. Now, this has again a massive impact, again, on a number of industries. Of course, oil refineries, oil mining businesses, drilling businesses are materially affected. Different countries have different break-even amounts for the price of oil. In America, the break-even is more around $45 a barrel. So most of the oil refinery and drilling companies and the shale producers in America would be running now at a loss, and they can only run at a loss for a period of time before they will shut down. Saudi Arabia and Russia can survive at prices of around 30, 35 just. Their costs of production are a bit lower. And what we've seen is this price war now between Saudi Arabia and Russia. So OPEC, which is the big conglomerate of a whole range of countries that control the supply of oil onto the market, what they initially were wanting to do is reduce the supply of oil onto the market, and in that way keep prices a little bit higher. But there was no agreement around this, and what actually happened was the exact opposite, with Saudi Arabia deciding to flood the market with oil and at a discounted price. Russia followed suit and also have increased as opposed to decreased the supply of oil, and that's partly also why the oil price suddenly fell so sharply. So that is another part of the whole story is on what's going to happen to the oil price. So the oil price, just to summarize, has fallen because of two main reasons. One, the global slowdown, which reduces the demand for oil because there's less production happening. And two, on the other side, is you've had an increase in the supply of oil with Saudi and Russia flooding the market. So those two things working together has caused the price of oil to collapse. All right, so this is really, I guess, at high level, the economic impact of what we have been seeing. Of course, there has been all the practical implications of what's been happening, and we see that perfectly in South Africa. We see that the schools have closed down. We see public transport systems having to be closed down or heavily regulated. Airline industry, of course, is virtually come to a standstill. We've seen all sports events cancelled. We've seen all church-type services, religious gatherings of over 100 people cancelled. There is regulation and rules now put in place for things like old age homes, elderly care facilities, for people entering it in and out. So again, this is coming from the direction of governments and really restricting the movement of people, which again, of course, has massive economic impact. So that is really the story of where we are, high level, the cause of the virus, the economic impact of the virus. So if I now just move on into what's been happening in the markets. Now, just to give you an example, generally speaking, gross domestic product of the world, so GDP, which is a measure of sort of global production, generally, it moves up and down year on year, depending on how the global economy is going. But for 2020, the economic forecasts a month ago was that global GDP growth would be around about 2.4%, which means that in real terms, the economy would be growing by about 2.4%, which would be about average to slightly above average for sort of long-term averages. Literally in the last 3 weeks, that has now been downgraded from plus 2.4% to somewhere between -1 to -2.2%. So you're talking about a 4.5% real decline in global production with a contracting or reducing global economy. Again, the technical term for this in economics is a global recession, which it is now anticipated that the world will be going into. And again, it's because of this and the people's pricing this into the stock markets that we see this massive drawdown in valuations and share prices across the world. The same thing has also happened in terms of interest rates. So we have seen a sudden and decrease across the world in terms of the treasuries or reserve banks of different countries reducing interest rates to counter this economic slowdown. So just to remind people, there are two ways in which, in tough economic times, government and policymakers can help try and keep things on track. And you've probably heard of it. It is called fiscal policy and monetary policy. So monetary policy is the central banks of countries. So in South Africa, the South African Reserve Bank, and the South African Reserve Bank and the Fed in America and the European Central Bank, etc., they are the ones that control interest rates. And in tough economic times like this, to help economic growth, countries generally will lower interest rates so that people have less of an interest rate burden in terms of the money that they have in their pockets. So we've already seen in America, interest rates have been reduced by 1.5%. They had a 0.5% decrease about a week ago, and they had a 1% cut a few days ago. So interest rates in the US are back down to zero. We've seen and are anticipating an interest rate cut probably here in South Africa imminently. There was one a while back, and the European central banks, the Australian central banks, Asian banks have all decreased interest rates. So we've seen monetary policy already happening. What we are starting to see now is the fiscal policy. So fiscal policy is the government's coming in with government expenditure type of programs or tax relief type of programs. So that is what we're starting to see now. Each government, each country is coming out on their own, putting out what they are going to, as governments, be doing to help the economy. So that will be things like reductions in tax rates, tax write-offs for certain businesses, government funding for small and medium businesses for short-term loans that they can try and keep going through these tough periods where they don't have cash flow, government expenditure in terms of other types of government programs to help create employment, etc. So we are seeing both now monetary policy and fiscal policy things happening across the world, across different countries. So let us just see what's happened in the market. So I have figures here as of close of business on the 16th of March, which is yesterday. And of course, it's not a pretty picture. If we take South Africa, first of all, month to date. So month to date, in terms of the South African stock market, the stock market is down 20.2%. And year to date, the stock market, the all-share index, is down 28.6%. Property, listed property, month to date, 23%. Year to date is down negative 37%. The bond index, month to date, is down 9.6%. Year to date is down 8.6%. And cash, month to date, is positive 0.3, and year to date 1.3. So overall, really massive declines in terms of across all asset classes. If we take offshore markets, a very similar type of a story. So I will give these numbers in US dollars. So in US dollar terms, the all country world equity index over the last month to date is down 20%. And year to date is down 27.2% in US dollars. In terms of listed property, we're down 25% month to date and 31% in year to date. And bonds are down 1.2% month to date and positive 0.7 year to date. So that is in US dollars. Of course, what we see in times like this, when it is a risk-off environment, is that emerging market currencies weaken. So the South African rand to the dollar has weakened quite significantly over this period. But this is not just a South African thing. This is consistent for all emerging markets. So don't think it's purely just for South Africa. So the rand has weakened by approximately 12% year to date. So if I give you now the figures in rands for offshore markets, of course we will add the rand weakness onto it. So as I've said, in US dollars, year to date, the markets are down 27% in dollars, but in rands, they are down 13.8% because we have added in the weakness of the rand. In rands, property is down 18% and bonds are positive 19% year to date. So The rand weakness, I guess, has helped cushion investments from a rand perspective. And as you know, across basically pretty much all of these select funds, in select diversified, in select guarded, approximately between 25 to 30% of the portfolio is directly offshore, and another 20% is in rand hedge type stocks. So about somewhere between 40 to 50% of the portfolios will have been cushioned or benefited a bit from this rand weakness in terms of the last month or so. So that's where we are in terms of the markets. Just to put it into perspective, these falls in the market are now as bad, and in some periods and in some measurements worse than the 2008-9 global financial crisis. They are in line with the 1987 crash, and in line and in some parts worse than the 1930s Great Depression. In terms of the speed at which the fall has happened, it's the fastest and quickest drawdown and speed in which markets have pulled back. So we are in unprecedented times, and this is really, in terms of what the world is facing with the virus and the steps that have been taken, is uncharted waters, not only for, the stock markets and markets, but for governments, health systems, and just generally the world's population. All right, in terms of the excess select funds, I will just give you an update quickly in terms of them and their performance. Again, we will distribute these slides. We may have already sent them out. If we haven't, I will make sure you guys get them. But the performance of the funds, this is as at the 13th of March, as yesterday's prices hadn't yet been captured on the system. But as at the 13th of March, which is Friday last week, if we just go and look at the fund performance, in terms of the Select Income Fund, month to date, so this is for the month to date March, as at the 13th of March, the Select Income Fund was negative 0.8%, and year to date, the Select Income Fund is positive 0.4%. The Select Guarded Fund, month to date, minus 5.9%. Year to date, minus 6.3%. The Select Diversified Fund, month to date, minus 9.1%. And year to date, minus 11.6%. And then lastly, the Select Equity Fund, month to date, minus 13.6%, and year to date, minus 21.1%. So, yeah, one can see quite large drawdowns across all of the funds. Having said that, in terms of the performance relative to peer groups, relative to the markets, we are in line, even slightly ahead of most funds or most peer groups. Of course, everybody has fallen. So from a peer group perspective, we look okay, and we are certainly in line with average or better. But of course, the picture is not fantastic for clients. And it's even exacerbated because, of course, we know the previous 3 to 5 years returns already have been below average across markets and asset classes. Just if I go and look a little bit at some of the underlying funds across the Select range, in terms of the Select Income Fund, year to date, the Coronation Strategic Income Fund is down 0.4%. Investec Diversified Income is in positive 0.7, and Nedgroup Investments Flexible Income is positive 0.5. So those are year-to-date, those three sort of enhanced cash type funds. In terms of the guarded fund, returns there across our 5 underlying holdings. Allan Gray, Coronation, Nedgroup Stable, and Nedgroup Core Guarded, in other words, our passive funds, have all performed fairly similar, down between -5 and -7%, so roughly quite aligned and slightly ahead of peer group. The standout fund that has performed the worst year to date has been the Prudential Inflation Plus Fund. That fund is down negative 11.5, and that fund is down more than the others, or average, because of its construction. So that fund holds, as per its benchmark and mandate, 15% in South African domestic property. It sets that weight, and because property, as we saw, was down heavily year to date, 37%, that fund relative to others has taken a greater knock. If I look at the select diversified fund range, our standout performer there year to date has been the Nedgroup Balanced Fund, which is managed by Truffle. That fund is down 8.2%, and otherwise all of our other holdings, Allan Gray Balanced, Coro Balanced, Prudential Balanced, and Nedgroup Core Diversified, the passive holding, are all down similar amounts, between roughly 12.5% to 13.5%, which is again in line with the peer group, if not slightly ahead of the average fund in that category. Then lastly, in terms of the Select Equity Fund, year to date, the funds have all been performing similar-ish. Allan Gray Equity is down 20%, Coronation Equity down 18.5%, Investec Equity down 20%, Nedgroup Rainmaker down 20%, and Nedgroup Value Fund down 22%. So those funds are all fairly much aligned and in line with sort of the indices. So that is where we are in terms of the funds, the underlying funds, and the markets, etc. What I'd just like to move on to then is what we are doing in terms of with you guys from information, communication, etc., just so that you know. So first of all, of course, we are in contact on a regular basis with all of our underlying managers. We get updates on them from them in terms of the funds. We can, of course, monitor the funds, and we have set up daily monitoring of all of the underlying funds to monitor their performance, to see how we are doing relative to the indices, relative to the markets, and to make sure largely that funds are correctly priced and that we can pick up any warning bells on underlying funds as soon as possible if we do notice anything. So we are keeping an eye on all of the underlying funds on a daily basis. What we are wanting to do as well, and as you would have seen sort of over the last 2 weeks or so, is, as you know, we send out every 2 weeks, we do that Monday morning voice WhatsApp message. We are going to increase that to weekly as opposed to every 2 weeks for the moment, just to keep you guys informed of what is happening in the markets. And of course, from feedback we've had, some of you send that on to your clients, which is totally fine. And so we're trying to position that as well, that it is useful information that you can send to your clients as well. We also want to send you, we did on Friday, and we will do it again this Friday, weekly updates in terms of just the fund performance, so that you know what the funds have done month to date, year to date, as at the end of the week, should you be having queries from clients, questions from clients, etc., so that you can just know, of course, the answers. We will also give you, where applicable, and send out updated market commentary, again, that you can either send on to your clients or for your own benefit. So should you get asked questions on and you want to obviously just give them a bit more detailed answer. So that's really what we are doing and will be doing with you guys. So our idea is to communicate as much as possible with you. Weekly, we will send you the WhatsApp message, as well as fund performance and some market commentary. So that's really where we are on that. Of course, if you have any other questions, please feel free to email myself or Sune, and we can try and answer you or help you with queries that you might have. Then lastly, I do have a few suggestions and have had a few questions in terms of things that you are facing, and I will just try and give you some of my suggestions and answers. I would say it's nothing rocket science and probably everything that one knows, but I think it's just worth repeating. So we have seen in the past, of course, in times like this, really from a behavioral finance perspective, how people behave. And it's totally normal and rational that in times like this, people are highly fearful and highly anxious and panicky. And it's in times like this that, of course, they behave very emotionally and often irrationally, because emotions are taking over from rationality. So your role as wealth managers and financial advisors at this time is really first and foremost to manage as best as possible your clients' emotions, and where they perhaps are wanting to do things that are sort of knee-jerk reactive to the market, as opposed to what will be in the long-term benefits of their financial plan. And of course, stating perhaps the obvious, the most clear thing would be where they wanting to instruct you to sell out of their investments and move it basically into cash, or perhaps like the Select Income Fund, a much more lower risk type of product. Now, history has shown us, and again, I was looking at the graphs just the other day, if you go and look at the Great Depression in the 1930s, you look at the 87 crash, you look at the IT bubble in 98, you look at the global financial crisis in 2008-9, where we have had these market disruptions of falls between 25 to 50%. In all circumstances, the times does vary, but in all circumstances, markets have recovered. And if you go and look at it, the recovery has very often been quite sharp and quick. And again, it goes down to the message that we've often told you, is that very often what happens is people will panic at the bottom of the market, move into cash, and then miss out on the very quick, sudden recoveries that will happen. Now, if we take the current situation into our minds with the virus and this current economic slowdown, the reality is the markets are currently highly anxious, highly fearful. There is a large amount of uncertainty in the marketplace. How long will this virus go around for? How long will it be before the hospitals get it under control, before governments reduce the spread of it? And how long will these travel bans and everything all be in place? Now, the one thing I'm pretty sure of is that as the weeks flow by now, things are going to become more clearer. Governments are going to see how the controlling of the virus is panning out. Are the procedures that they're putting in place helping or not? What tweaks they need to do? And what drives markets is certainty as opposed to uncertainty. So a vast amount of bad news has been now priced in. And as we go forward in time, my feeling is things are going to slowly become more clearer and more certain. It might not be good news, but it will be more accurate information. And as things become more accurate and certain, and people can start forecasting things more accurately, prices can then adjust. So my feeling is as time progresses, certainty will improve and markets may start recovering, and they can recover quite quickly as the certainty becomes clearer. Does that mean it's going to recover totally to where they were? Probably not, and that will take time because, as we're saying, the reality is we have a major global recession and economic downturn. So that does imply lower prices. So I think the short summary of what I'm saying is nothing new, is that please, you need to manage your clients' emotions. You need to try and avoid switching out right in the peak of the heat of the boiling pot. Markets have severely fallen already, and the chances are if you sell now and move into cash or cash-like products, that you are locking in massive capital losses and probably will miss out on some of the recovery, which will be sharp, short, and quick. So you need to stick to your investment plans, stick to the long-term investment horizon, and unfortunately, I guess, just take the pain with your clients in the current process. Now, one of the questions, of course, is clients that are taking income, and what can you do about that? Now, people, again, we know, generally are probably already taking too much income, or even some clients who were taking reasonable amounts of income. Of course, their capital values will now have dropped, and so they will be worried about their income going into capital portions or the income falling. And again, unfortunately, there's no rocket science to this. So one cannot avoid, I mean, markets have fallen, capital values are going to fall, and as a result, yes, people are going to start drawing down into their capital. And of course, the easiest and best thing to advise clients now is for them to reduce their income requirements. This will place less burden on the capital, and ideally this is a short-term, when I say short-term, 1 year or so horizon, where if they can reduce their income requirements, it would certainly be helpful and ideal. I know most clients do not want to reduce income, or they physically cannot reduce income. Then there's very little that one can really do about things, except, again, still I urge them to just sit tight, and markets will recover in time, and capital values will recover in time, and income then, I guess, will place less burden on it. That would be for existing clients. I do think there's a separate scenario or environment where you're coming across new retirees or people with income that are looking to invest. There again, I think you should just follow your normal financial planning advice and procedures. However, you do need to, of course, I think, stating the obvious, take caution of the current economic climate. So I feel that we are in tough times, we're in uncertain times, and it probably is not prudent to just go and fully invest clients' capital at this point in time. And I would suggest a phasing in type approach for new money into the appropriate funds, and possibly clients going into the markets, over the next 3 months, over a 3 to 5 year future time horizon, potentially actually might do really well. But I would suggest phasing in at this point in time over a period of time into the markets and err more towards conservatism, just given everything that is going on in the markets at this point in time. In terms of recovery and how long is it going to take for markets to recover, for the oil price to recover, I've had some questions on that. Well, again, it's impossible to give you perfect answers. I can only tell you what I've already said, and I won't repeat it all. The best indicator, I guess, is going back in time to similar periods like we're in now to see what has happened. And I mentioned the various periods earlier. If you look at the Great Depression, the 87 crash, IT bubble, global financial crisis, it varied, the recovery time varied between 4 months to 20 months. So let's call it 4 months to 1.5 years for that recovery process to happen. As I've mentioned, this is a first for the world that we're in, facing this type of an issue and crisis. So there is no perfect science to this. But as I've said, even the scientists, the medical doctors, all are consistently saying that it is just a period of time for this virus to get contained, for a vaccine to come out within 12 months or so. So this will pass. And when this passes, the markets will recover. What time period that will be is impossible to say, but history has shown somewhere between 6 to 18 months. So basically, again, the old story of sitting it out, taking the pain, but having to just wait for that recovery to happen. There's no magic here or magical cures here. In terms of the oil price is going to be majorly linked to the economy and the economic pickup. I don't think or see the oil price recovering in the near future because of the economic slowdown. But again, as the virus gets under control, as countries start reopening their economies, global travel, global demand for goods and services, factories reopen, go back to full production, without doubt the demand for oil and metals will increase again, which will put upward pressure on these prices. Will they go all the way back up to $65? I don't know, but the chances are they certainly won't be at $30 anymore. There are some silver linings in everything, is that dislocations like this often get rid of inefficiencies in economies, of businesses that are not efficient, and of production and factors of production that are not efficient. So over a slightly longer term, the net outcome of all of this perhaps could be greater efficiency in terms of production, and those businesses that have survived will be far more efficient, and actually consumers will ultimately benefit. And finally, just in terms of what type of returns can we expect going forward, again, it's impossible for us to determine this. The best way or best predictor of future returns is current valuations. So we are now at obviously extreme valuation levels on the lower end. Part of this takes into account the slowdown in the economy, but part of this is definitely pricing in fear and anxiety. So the upside returns are generally, as I've said, pretty positive post this and when markets can recover. But it is impossible to give you predictions for future returns. What we do know in South Africa in terms of the asset classes is that currently bonds or fixed income, which are giving you yields of around about 10%, inflation is around about 4%. So you are getting real returns of 6% or so for fixed income, which is an extraordinary high level of real returns for bonds. This is a good investment opportunity, and it's also very good for South Africa because it attracts foreign capital, because the real returns that foreigners can get on our bonds is way higher than the returns they can get from most developed country fixed income bonds. So this is good for our capital flow account and our currencies. On the equity side, South African equities are certainly relatively cheaply valued at this point in time, some sectors more than others. But before even this whole coronavirus issue started, as you know, the South African economy was already struggling. Of course, this virus and global slowdown will put even more pressure on our South African economy. So we don't expect the South African businesses to do fantastically in the short term, but one, post the virus issues, and second of all, if government can structurally get the South African economy into a growth projection, the South African equity market could show really great positive returns on a 3 to 5 year investment horizon. As things stand now, it's still not looking fantastic, but valuations show that there is great upside potential based largely on us needing economic growth within South Africa. And then lastly, in terms of property, the property sector is taking massive strain, one in South Africa and two globally. There is a massive movement in terms of trends around the world, in terms of shopping, consumerism, we know, towards the internet and away from shopping centers. So this has caused retail shopping centers to be priced lower quite materially, pushing listed property prices down globally and in South Africa. We know economic slowdown is causing consumers, retailers to struggle, which is also puts rentals and rental increases under pressure, which is not good for listed property. And I think that commercial property is going to come now under strain also with this economic slowdown, and as people are going to increasingly work from home and not in formal offices like we know. So we've seen a massive slowdown and reduction in property valuations, which is translated, as we've seen right at the beginning, into the listed property stocks being the one sector that has fallen actually the most. Again, for this to turn around, we need economic growth. So we need businesses to continue to do well, consumers to do well, and we will see, and we have seen, a restructuring of traditional shopping centers as they reposition themselves for a whole changing consumer market. All right, so guys, I've gone on for 45 minutes, I think. I know I've covered a lot and given you a lot of information. Hopefully that is helpful and helps you speak with your clients, understand what's going on in the world, the economy, the funds. I'm happy to take, let's take 3 to 5 questions if there are, and then we can call it a day, because I am sensitive that people have other things to do. So thank you all for dialing in. We had 200 participants, which is amazing. Hopefully you found this helpful. And I will open it up for 1 or 2 questions now. So does anybody have any questions? No, last chance. Are there no questions? Which I'm hoping means that we have managed to cover most of the stuff. Last chance. Does anybody have any questions? No. Okay. All right. Well, it's great. Doesn't seem like there are any questions. Thank you, everybody. And please, sending you all strength. Look after yourselves. Stay healthy, first of all. And I know this is tough times for you with your clients. And I urge you to just please try and communicate as much as possible with people. Once people know what is going on, I think their nerves are put at ease largely. It is tough times, and we need to just work our way through it, I think. So please don't hesitate to email us anything if you would like, and we will be in regular touch with everybody. And at the end of this week, we will send out updated performance and market commentary. Thanks, everybody, for